Good evening. I'm Peter Resnick from ShadowTrader.net, and this is another edition of the ShadowTrader Video Weekly. Where to begin? This was one of the craziest weeks we've seen in a very long time. Very hard up, very hard down, culminating in a huge sell-off on Friday. We had the Fed, we had tons of news. The market is really just all over the place right now, and the outlook is really cloudy. So in the spirit of that, I thought I'd just make a PDF with two columns on it. Bullish side, bearish side. And I started writing down all the factors, first technically that were bullish, all the factors technically that were bearish, and then I listed all the fundamental things currently happening and coming on the horizon that were both bullish and bearish. I'm going to go through that whole PDF with you guys together. We're going to look at some charts and market profile at the same time and see how it all ties in and see if we can get a better feel for what's going on in this crazy market right now. All right, let's get to it. Come on. Okay, so starting off with a 15-minute S&P this time. So we can just go over the action of the week and you'll see actually just how crazy it was and where the inflection points were. So this is the FOMC announcement on Wednesday afternoon at 2 p.m. And you can see there was a huge rally as the news was very dovish. Basically, they reiterated that they're on pause for all of 2019. It's looking more like the idea was that it was going to be either 0 or 1 hikes in 2019. Now that has gone down to 0, and there's even talk that there might even be a cut. So obviously the market loves this. So you get a huge rally about an hour or so, and then it just starts to fall apart, and they sell it off hard into the close on Wednesday, which leads to a gap down on Thursday and a very powerful trending day, which rallies all day. And then Friday takes that entire day back, opens on a gap down, trending day down, takes back the whole thing. All right, so where does that leave us in the bigger picture technically? Right at key trend line support in the SPX on the daily. You can see here, this is the dominant trend that's been happening since Christmas or so of last year. And in the NDX, it's interesting because we have actually quite a bit of room to go before we hit the trend line. So these two things may come into play together. If the SPX is to break trend, it'll probably bring the SPX down with it. And then the Russell, which has been the wild card all along, is really, I think, one of the bigger catalysts in dragging this market down at the end of this week, because you can see obviously that same trend from Christmas broke a little bit about 3 sessions ago. This was on Wednesday, and on Thursday there was a huge fake out move. And I actually thought this was going to be bullish. I really thought that the Russell actually showed a lot of relative strength here on Thursday. And as you can see from the trend line I drew, it did exactly what it needed to do to right itself, basically. It negated the trend line break underneath and then had a strong bar that obliterated the prior day and went where? Right to the trend line resistance, closing strong near the high of the day. So obviously a whole lot of mixed signals, right? I'll be the first one to admit that upon the close of Thursday, I thought this market was going much, much higher, given that huge reversal with the trending day in the SPX, relative strength in the Russell, reversal in the Russell, and then, as we can see, Friday happened. All right, so that being the case, I thought it'd be a really good time for us to look at a matrix, so to speak, of what is bullish and what is bearish in this market. So I've written down all the factors that I think are contributing to either side. And the way this is set up in this PDF is that obviously it's the bullish on the left and the bullish on the left, bearish on the right, but the line is that you have technical analysis above, and this stuff here is all fundamental. And I want to go through all of it with you, looking at some charts as well as we go. So let's just start from the beginning. Bullish. Trend is still intact in the SPX and in the NDX. All right, we've already talked about that. Let's just reiterate. That trend line is not yet broken in the SPX, and in the NDX, it is well above it. Okay, SPX and Dow and NDX are above their daily 50-period moving averages. This is important. Most institutions will not get heavily bearish unless you lose the 50. You can see here that in the NDX, it's way down here. In the SPX, the 50 is also way down here. Dow, right, way down here, somewhat below us. And of course, the Russell has lost it, but we'll get into the bearish factors shortly. Okay, melt up signs still there this past week. I was going back and forth with myself a little bit if I still wanted to include this, talking about, given that I'm recording this video after Friday, and obviously there's no melt up going on right now, but it was a melt up until Friday, all of the classic melt-up signs were there. How do you know that you're in a melt-up? This is something that I talked about with my weekly option subscribers and Peter's Pre-Market Perspective subscribers earlier in the week. I gave them the rundown, which I'll give to you now, of how do you know that you're in a melt-up? And essentially, you're in a melt-up when you have three specific factors. One factor is obvious. You have to be going up almost every day with very small pullbacks, right? The second factor is that when you do pull back, you pull back to very, very specific market profile type, nuance type references, right? And these references are very, very nuanced, and not a lot of people know about them. As a matter of fact, many times these reference points, such as a volume POC or a value area low, etc., this is just self-fulfilling prophecy, where it just happens to be that an inordinate amount of volume transacted at that level, and short momentum, day time frame type players don't even know why they are buying and selling at those levels. It just happens that way, okay? And thirdly, the last factor that tells you that you're in a melt-up is that the breaks that do occur are of the liquidation break variety. They are hot and heavy, and they seemingly come out of nowhere, and they fall very quickly out of essentially bullish patterns with no warning. And when they do, they are constantly strengthening the market. They're not real pullbacks where there's like corrective activity where longer term sellers are selling. It's just that these momentum players that are controlling the market, they run out of bullets, they get themselves too long, and there aren't really enough new money buyers behind them to keep it going. Momentum players, as we know, chase price higher. They don't act the same way that new money longer term buyers do, who sit on the bid and sort of support the market, let it come in a little bit and accumulate positions. They're just sort of buying and pushing it up. And what happens then is when we have these liquidation breaks is they take potential sellers out of the market, essentially strengthening it. All right, so those are the three factors of a melt-up. And up until Friday, all of those factors were in play. We had a market that was constantly going up. We constantly had liquidation breaks coming out of nowhere that were strengthening the market, and we continually had lows put in the market where the market would come in right to very, very nuanced market profile levels. It would stop there multiple times and then kind of turn around and go up. All right. Now, obviously, after Friday, we're not seeing that this much. All right. Last item on the bullish side is tech leading FANG bullish XLK. Again, this is somewhat different after Friday, but for the most part, these stocks for instance, FANG technology, they are still pretty strong, especially Facebook is kind of just in the middle of this range, and Amazon had one of the best weeks I've ever seen, where the stock just literally just almost didn't even have a down day and then broke its trend on Friday. If you look at XLK as a proxy, really very, very strong. It appeared over the course of the week that money was going out of financials and into tech. This is a very, very important thing, which has been acting as a big drag on the S&P. The reason that financials were weak is obviously because of what happened with the Fed, and I'll get into that in a second. All right, let's move over to the bearish technicals. All right, Russell is rolling over, lost the daily 50 MA. This is a risk off signal. We talked about this already. I'll just show you the chart one more time. You can see clearly the rut has lost that 50 and, as I said, is starting to roll over. This is generally a bearish signal because the small caps are considered either a risk on or risk off indicator. Because they're slightly more riskier stocks, you get a little bit more bang for your buck. They tend to run harder when the market is rallying, and they come off quicker when the market is falling. So it's a kind of a risk off signal that the Russell is leading the market to the downside. Financials very weak, will drag on the S&P. As I started to mention earlier, financials have had a lot of the air sucked out of them over the past week, and much of that is due to the Fed. The Fed said that essentially they were going to stay lower for longer, that interest rates wouldn't keep going up. This, of course, is not good for financials, and we saw them on, for instance, on that Wednesday, like look at GS. This is Friday, look at Wednesday here in GS. It was already coming off big after a false breakout. This is very, very interesting as well, specifically to us, because this was a play that I had long on this breakout in my weekly options advisory, and it was working great for a day and a half. It was really a phenomenal setup. I talked about this in the video, I think, in prior weeks, saying, look, I'm going to buy this GS on this breakout of this pattern, and ended up getting long call spreads right here on this day, just even before we broke out, just as we started moving early in the morning. And they worked out phenomenal, like I said, for a day and a half. And then as soon as we came back to the breakout point dumped them for a very, very tiny loss, almost break even, because you could see it wasn't working. And thank God we did, because notice that what happened after that, it just got destroyed, much, much weaker than the market. And again, this is due to the Fed. And as this was happening over the course of the week, we still saw Amazon, etc., rallying every single day, and it appeared that money was coming out of financials and into tech. So there was that sector rotation as well going on before Friday, and that also to me was a very, very bullish sign, because generally, as I've mentioned a few times in the past, when a market is out of sync like that, that actually helps a market. You have the money, it's sort of a passing of the baton effect, where some sectors are weak, some sectors are strong, some indices are weak, some indices are stronger, and they kind of push-pull each other. And when one is ready to take a pause, the other one picks up the slack and you start to move up. So that was another reason why I was very enamored of this market, bullish, from a bullish standpoint before Friday, because this dynamic was occurring. All right, let's continue back on. Market profile is all over the place with poor structure on the upside. I'm not going to spend too much time on it, but yes, it is essentially true. Basically, that Fed day was a multiple distribution day. That was the, the Thursday, I should say. Fed day was the up day, down day, and then Thursday was the follow-through rally. And you can see the follow-through rally built itself straight from the open. The green button here, dot rather, is the open, and it was just single prints all the way up as a lot of short covering occurred. And then notice that in between you have single prints here and single prints here. Whenever the distributions are divided into multiple pieces like that with single prints in between, it's generally not very good structure. It can and very often is the basis for the beginning of a rally. So I thought it was okay at the time, especially given that we closed at the top of the range, and the volume point of control and even the time spent up here all migrated up to the top of the range. That's a bullish sign. So again, this is why, coming out of the Fed and coming into Thursday and during the day Thursday, I personally was getting more and more bullish. Obviously, I had no idea what was going to happen on Friday, but all the signs were pointing to that this was going to, continue to the upside. All right, let's continue on. Okay, VIX explodes 20% back up into range, more than expected. I have been mentioning the decline in volatility for some time, specifically talking about the break of this 1350 area, and wondering if that was going to send vol on the weekly chart back into the 11-12 handle around here. Well, on Friday, there was a huge change. This was a 20% move in volatility. VIX was up 20% at the high of the day, maybe even a little bit more. The reason I point this out is because whenever you have these minor liquidation breaks like we've had in the past, you do not get this explosion in volatility. It's like the options market, or the bigger players know. They know what's a liquidation break, and they know what is more sustained selling. And when you get this more sustained selling like Friday, you get this pop in volatility. It is a warning sign, so it should be paid attention to. Huge increase in NYSE volume on Friday. This is another thing that we haven't seen in a little while. For this, I point you to my mentor in the profile, Mr. Jim Dalton, on his website. It's jimdaltontrading.com. He has this NYSE volume, 4.2 billion on Friday. And look at the difference. You can see here these numbers every hour, or half hour, it's calculated how much it is percentage increase from that same time the prior day. In the first half hour, trade volume went up 35%, and by the end of the day, it was running at 18.5% higher. So that is also a slightly more bearish sign. That's why obviously I put it into the bearish column. Expansion of volume on the downside, not very bullish. All right, now let's talk a little bit about these fundamentals, and here's where we're going to get into what caused this activity on Friday. All right, or actually before. So in the bullish column, there's only one thing really, which is Fed terms very dovish, and I said market generally follows. Market is very, very sensitive to monetary policy, and the bigger moves in the market tend to be driven by what the Fed is doing. Yet another reason why when the huge follow-through day occurred on Thursday, it was all the more reason for me to be thinking, okay, this is very, very bullish, because obviously the market is basically answering what the Fed did, and answering in the affirmative, I should say. Yes, we like it, and we had that big rally. But obviously after Friday, everything changed. So what were some of the more bearish fundamental factors that caused the move on Friday and are in the bearish column here. Okay, the first one was the Germany slowdown. I put this one specifically at the top because it's actually the exact thing that made the futures drop hard on Thursday night, Friday morning. It was at 5 a.m. our time when they fell. And it was essentially because of the Germany PMI, their purchasing managers index, their manufacturing index came in very weak and was indicating contraction, and that knocked the futures down quite a bit. All right, so that is really our number one concern right now, really, is the European slowdown. Beyond that, I wrote here Chinese slowdown. This is always on the horizon. This has been talked about for a while. Obviously, the economy there is still growing, but it seems like it keeps growing less and less each time, and they do tend to fudge the numbers a lot, so who really knows if we know exactly what is going on over there. But that is also definitely a bearish concern going forward. Brexit got delayed this week, but nowhere near resolved. So they got an extension on time. Apparently it's not happening at the end of March, but again, there is no resolve as to exactly how they're going to move forward and make it a soft landing in terms of trade and other. Okay, yield curve inversion. This is a biggie. Short durations only so far. This is another thing that added to the huge decline on Friday was the yield curve inversion. And for those of you who don't know, if you're asking yourself what exactly is the yield curve inversion and why is it important, it's very simply when the rate on short-term treasuries exceeds the rate on long-term treasuries, and that curve gets inverted in a way that it shouldn't be. Obviously, long-term money should pay more than short-term money, but what happens is that when panic sets in or people get more fearful and risk-averse, they pile into those long-dated treasuries, which of course pushes their price up and their yield down. And therefore, with those backdate, those further out treasuries yields falling, the ones closer up are higher. Now, this is not a total yield curve inversion yet, I should say, because only the shortest maturity has actually inverted. So if you can see in this particular little graphic here, you can see that the 1 month and the 3 month yield, okay, in here is lower than the 10-year. But these later ones here, now typically in the for the yield curve to actually invert, economists are actually looking for the 2 versus the 10, so the 2-year versus the 10-year, and that obviously hasn't yet. You can see there's still a little bit of spread between those. The 2 years at 2.366 and the 10-year is at 2.473. Why is this important? Over the last 65 years, I believe it has predicted every single recession. So, but before you get all scared and think the recession is happening tomorrow because we've started to invert, it usually takes 6 to 8 months for that recession to start. So we shall see. All right. Next thing, tariffs, trade, China still not resolved. Obviously, a lot of posturing in Washington, but nothing is resolved yet. This could be a wild card. If this doesn't go well, this could also rattle the market somewhat. And last but not least, purposely I put it at the end, and I'll tell you exactly why. Mueller report coming soon. This is interesting because I wrote this in the afternoon before it actually came out. Then by the time I started recording the video, I had already made this PDF. Apparently, the Mueller report has been turned into the Attorney General late this afternoon. I'm recording this on Friday evening around 6 p.m. I purposely put this last because this will probably take some time before we see if it either comes out partially, comes out in a very redacted manner. How much are they going to show us? Are they going to show us anything? Who knows? It's not like we're going to get a full report early next week. At least I don't think so. So this could take some time, but it is a factor going forward because obviously, anything that could lead to a change in the current administration, then people would assume that would also lead to a change in policy, which would mean possibly scrapping the tax cuts, et cetera, et cetera. The things that are going on that the market likes, I think that's the real fear here as far as the report is concerned. So there you have it. That is my matrix of bullish and bearish factors, technical up on top, fundamental on the bottom, and obviously the right-hand column is a little bit bigger than the left-hand column. A lot of the reason that it's bigger, obviously, is because of these fundamental concerns, because I can't really see anything all that bullish fundamentally other than the fact that the Fed has put the rate increases on hold. All right, so where does that leave us going forward, and what is my plan? SPX sitting right at the trend line. I'm going to assume that it is possibly going to break. If we get some sort of a weak rally here and retest, that is a short point. And we are also going to assume that some of this froth in the NDX could come out. And if it does, it's probably coming to the trend line. And I'm going to leave you on this note because this is exactly where that whole push-pull thing between the indices being out of sync comes in. What's probably going to happen, I can't be 100% sure, but is that the SPX will break trend, move definitively lower. The NDX will also look pretty ugly, sell off, but it's going to come to this trend line support, and that's going to turn the entire market around. And then we'll see if we go back to where we were this week at some highs, or if it's a much lower high and we continue to roll over. As always as well, pay close attention to that Russell because it is the wild card. It is very, very weak, and continued weakness without any buying pressure coming into the Russell will probably also be a negative catalyst for the market going forward. All right, so there you have it. I've laid out all of the factors that are either bullish or bearish going forward. Now, obviously, if you're a short-term trader, you may be thinking, great, volatility increase, bring it on. This is going to be great. You don't really care which direction it's going to go. But if you're more of a longer-term investor, then maybe some of the factors that I laid out may have some impact on your activities going forward. Thank you to everybody that has sent in video testimonials thus far. If you haven't yet, I'd really love to hear from you. Remember, just landscape view, hold the phone like this, selfie, or have somebody else do it for you, tripod, whatever, 10, 15 seconds. Tell us what you like about ShadowTrader and if we've been helping you. I've got about 9 or 10 of these already in the can already, and they've been great, and I do appreciate everybody that's been sending them in, but I would love to get tons more, so please do if you can. And last but not least, I wanted to mention that a gentleman named Ron Ianieri passed away earlier this week. He was kind of a giant in the options education industry. He was a dear friend of ShadowTrader and taught me a lot about options, and a very colorful individual, and he will be missed. So rest in peace to Mr. Ron Ianieri. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, as always, I'm wishing you good trading and good night.